You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. How are you doing this morning? I know I'm late, but I have a pretty good reason. I actually spilled my coffee. I spilled my coffee this morning because I was looking at Scotiabank earnings and yeah, that was a disaster. And I'm not just talking about the coffee being spilled across my passport because I'm leaving next week and the rest of my desk. It's actually a big mess because Scotiabank literally dropped a bomb yesterday and some people will not notice, and it's unfortunate. But it's actually in my opinion, it is a very big bomb. I'm going to get there in a second. But first, let's quickly talk about earnings here for the quarter. So earnings per share, $1.58, $1.58 compared to $1.69. It's down 6.5%. Not great, but I cannot really compare to the other banks right now because I have not reviewed all of them. I will prepare a video on my YouTube channel next week. Well, will review like all banks. Talk probably a little bit more about Scotiabank and about what I'm going to tell on the podcast, and also about TD situation with anti-money laundering practices that went wrong. And now there's an investigation. So we're going to talk about the possible impact on that video too. Now, going back to Scotiabank with earnings per share at $1.58. So for the quarter, they are paying a dividend of $1.06 for a payout ratio for that quarter of 67%. So 67%, not an ideal payout ratio. It's not bad, but for banks in general, they are around 50%. The best of them are slightly below 50, in the 40s, like around 45 or something like that. So if you're above 50, it's not that great. If you're above 60, you kind of suck, and now you're getting close to 70%. Well, and there's the bomb. Scotiabank kind of forgot to increase their dividend. And I found it very funny because I had to go into the transcript of the earnings call to find a little bit more information on it because it was not on the press release. And my good friend Mark McGrath, CFP, we tend to tease each other on Twitter from time to time. He's an index investor. I'm a big fan of dividend growth investing, but I kind of highlighted that news yesterday, and I was busy on a lot of things, so I didn't spend much time watching earnings this week. So I'm not up to date on banks. But then I thought, you know what? That news caught my attention. So let's go on the earnings transcript and see what's going on. So Mario Mendonca, probably like an analyst, said, okay, and then again, this is something I may have missed. So yeah, we may have all have missed that. I thought the cadence for dividend increases was every Q2, but again, I may have missed this. I don't see a dividend increase this quarter. So historically, Scotiabank increases its dividend every Q2, but not this time. And then Raj Viswanathan, sorry about that. Sorry, Raj, about that, replied, no, you haven't missed anything, Mario. As always, I think, yes, there is no dividend increase this quarter. Okay, there's no dividend increase. It's part of what we're thinking is what do we want to grow dividend in line with our earnings growth, which is not growing for a few quarters now, which we know is going to happen in 2025, rate situation and other stuff to contribute it. So we decided that it's better to take a pause at this time, and we should start commencing our dividend increases in 2025 in line with what we do every year in the second quarter. I'm going to let that sink in. Don't spill your coffee, please. But yeah, so long story short, no dividend increase in 24. So already Scotiabank was lagging in terms of dividend increases over the past few years. They were showing a higher payout ratio, a lower dividend increase rate, and now, we're just going to take a pause. And this situation is big. And then when I tweeted about it, I got a lot of investors to just say, yeah, but Scotiabank is paying like a super generous yield. I don't really mind. I'm patient, yada, yada. And I'm like, all right, that's fair. I mean, you may fall for the yield at 6.5%. I get that. But it's been years, literally like several years, that financial metrics, I'm not talking about stock price performance because that could be fluctuating according to market sentiment. So I'm really talking about looking at the revenue, the earnings, the payout ratios, the dividend growth across all the big five. And we're going to jump in and we're going to add National Bank on it. So on the big six, and Scotiabank lags big time on pretty much all indicators. And just for fun, I just wanted to see what it would like. And this is what the whole point here today, not to play Monday morning quarterback, but 5 years ago, I was pretty adamant that Scotiabank was not performing in terms of financial metrics. Again, not the stock price, even though the stock price was a reflection of poor financial metrics performance. But I just thought, okay, so imagine that you have the chance like 5 years ago to invest in Scotiabank or Royal Bank. So back then, Scotiabank was offering a yield around 5%, was trading around $70, and the latest dividend payment was 80 cents a share. That was about to be increased a few months after. For Royal Bank, trading at $102, $1.02 in dividend for a 4% yield. So imagine that you have $100,000 and then you invest in BNS and Royal Bank. So $100,000 in BNS gives you 1,428 shares, while you may have 980 shares for Royal Bank. So fast forward today. This morning, when the latest payment came out, like not this morning, but like the latest dividend payment for Scotiabank, it's $1.06. So that would give you for the year, because there's not going to be any increase, $6,054. So $6,000 in dividend. That's pretty good. $6,000, I would take that. If you had invested in Royal Bank today, you would receive a dividend payment of $1.38 per share. So for a total of $5,400. So the difference between $6,000 and $5,400 is roughly $600. And keep in mind, it's going to be a little bit smaller at the end of the year because Royal Bank has already increased its dividend once this year and typically should increase again later down the year. So if it's still true, you can think that the difference will be anything between $550 and $600. That will be probably the difference between investing in Scotiabank and Royal Bank. So $600 difference per year in dividend. But now let's take a look at the value of your investment. So the $100,000 that you invested in Scotiabank is now worth $93,000, so down $7,000. All right. So even a full year of dividend is not even enough to compensate that. For Royal Bank, 140. I have to repeat that: 140 versus 93,000. So to get a little bit more dividend, and of course, like now you're going to tell me, but Mike, you don't consider the dividend each time. Yeah, okay, that's fair. But the difference between Scotiabank and Royal Bank is less than $1,000 a year for 5 years. And 5 years down the road, your investment, the difference is almost $50,000. You're not going to compensate that with a few bucks in dividend. My point here, not to play Monday morning quarterback, that would be too easy. And you could tell me that I'm cherry picking. I could take in another one. Actually, if I taken National Bank, would have be even worse. My point here is, if you go for the yield and the company does not show strong financial metrics like earnings growth, revenue growth, that does not do well compared to its peers, well, this is what you're going to get. You're going to get a yield. You're going to get a dividend that does not increase with to match inflation. So this means that you may receive $6,000 in dividend today from Scotiabank for the year, but that $6,000 is worth less than what it was last year, and it's like a passive dividend cut, like 2-3%, but that's 2-3% of buying power that you don't get. Now, fast forward that for the next 20 years and look at the impact of that 2-3%. It's huge. It's huge. So by focusing on the yield, ignoring financial metrics, and just falling in love with the high income, you leave ton of money on the table. I would not do this podcast if the difference between Scotiabank and Royal Bank would have been like $5,000-$10,000. I would have been like, yeah, $10,000 over 5 years, not the end of the world. You could go for the yield, and it's not going to have a material impact on your retirement and on your portfolio. But in this case, we're talking about $50,000 difference over 5 years. And imagine going forward, what's going to happen. Like, one is growing, increasing its dividend. The other one, taking a pause. I mean, come on, you have to review your stuff. I'm not here to give you financial advice, but I'm here to tell you, you should have a clear investment process. That is just like very important, and focus on metrics. Stop hoping and start analyzing like real numbers. It's super important. All right, Moose. So sorry for this longer podcast than usual, a bit like a few seconds more. Just wanted to let you know, tomorrow I'm hosting a webinar, moosemarkets.com/webinar. We're going to talk about what to buy, how to buy quality income stocks at this all-time high market, and also how and when to sell. So you could guess that if you ask me when it's the right time to sell Scotiabank, I kind of have my idea on that, but I'm not going to tell you today. You can register at moosemarkets.com/webinar to either watch the live event or see the replay later on. Everybody will receive it as long as they register. All right, Moose, that's enough for today. We're going to talk again tomorrow. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.